Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonneau, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validea Capital Management. Matt Ziegler is managing director at SunPoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or SunPoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or SunPoint Investments.
So Matt, today we're going to talk more about the 60-40 portfolio and alternatives to it.
I can't wait. That's so exciting. Is it dead yet?
Well, we're going to get into that, but we've done a lot of episodes about this. But one of the things I was noticing when I was going back through our episodes and what a lot of other people do is a lot of people don't really look at this practice. Like we talk about, oh, is the 60-40 portfolio dead? Is it not dead? Do you need other asset classes in your portfolio? But we don't take it to the step of like, how do we actually in the real world build a portfolio that goes beyond the 60-40 portfolio? If we want to do that, what are some ways we would think about that? Now, obviously the way I do it, the way you do it, the way some of the other people we look at in here do it, there's no right way to do this. But I'm a big believer that if you're going to do it, you probably want to have some sort of systematic rules or some sort of process or something. You don't want to just be haphazardly throwing a bunch of stuff together. So that's what we're going to do today. We're going to talk about the 60-40 portfolio, other ways you can go beyond it, and practical ways we actually do it in the real world.
Over and over and over again, we meet with clients who have a portfolio that they put together, or once in a while they worked with an advisor and put it together, or they worked with two different advisors and didn't tell each advisor they were working with somebody, or whatever the circumstance. And all of this theory serves the role of being able to take stuff and recategorize, just like having a framework for thinking about it. It's like building a house without a blueprint. It's okay. You can cobble something together sometimes with just the way things happen and occur. But if you actually want to structurally assess something, you need this logic, you need this math, you need a common approach that allows you to tag and understand all the elements of a portfolio so you can make sense of it. And certainly if you're building something from ground up, the difference between calling your cousin and saying like, build this shed for me, and like actually like, I don't know, going to wherever, Home Depot, and like getting the exact parts with the instructions and all the things and whatever to do it yourself. Having a template to understand everything and where it has its place and what you expect it to do, even if that's not perfectly right, it's still useful, and it's part of being a professional.
Yeah, what we're trying to avoid here is what you see a lot, like in terms of people who come to us in the real world, which is they go through 2022, they're like, oh crap, I need something besides stocks and bonds. Let me put these commodities in there. And then basically the commodities don't work. And then the commodities are suddenly out of there again. And so like that's what you don't want to do. So like some sort of process to determine you can have a static allocation across asset classes that you hold for a long period of time and rebalance. That works. You can use some sort of process to balance between these things. That works too. What doesn't work is that. And so that's really what we're trying to avoid is the emotion gets in here. You haven't seen an inflationary period in forever. You see it in 2022, you're like, crap, I'm totally wrong about this. I need this thing. The thing goes in there. The thing starts underperforming. I'm like you now saying the thing. And basically you got it, and then the thing is suddenly out of there. So that's what we're trying to avoid.
But that's what it turns into. It becomes the thing. It becomes like, I'll never forget a few years ago with a potential client coming in, and they had all this money in these crypto gains when that stuff was still new. So this is 5 or 7 years ago. This is pre-pandemic. When was the first big run up in crypto? Whenever that was, it was somebody came and they were like, I have a thing. And it was, the scenario was a person, this woman had like dated this person who was some tech programmer out in like Silicon Valley somewhere, and had talked her into doing this. And you got to buy some of these various coins and a bunch of Bitcoin at this one point in time. And she was like, okay, sure. And did it, and then forgot about it. And then in that first or second giant run up, this now ex calls her up and says, hey, did you ever get rid of that, or do you still have it? And this woman finds out she was worth now, almost $1 million worth of like crypto out of a very small investment. So she was very excited about all this thing. But at the time, the wallets were tricky, and she could only get like $10,000 at a time or whatever else. So we talked her through this thing, and she's going, well, maybe it's going to go to the moon. And then it falls off the cliff. And so she lucked her way into a situation, rode it all the way up. It was too much work to start getting stuff out. So she slept on it. Like 6 months later, she calls back and she's like, so I didn't do anything. Now it's worth like a third or a quarter of what it was worth. Like, do I do anything now? Is it still worth it? Should I be dumping it all so I still have anything left? And that's what we're trying to avoid here. All the behavioral problems that go on when we get excited about it or we get disappointed in something and we have no process, we're exclusively at the whim of our emotions. And last I heard, that's not a good way to invest, Mr. Quant, is it?
That is true. So let's start basically with why you might need something beyond the 60-40 portfolio. First, the pet peeve of mine, and you were saying this to me in the 4% rule episode. I believe what you kept saying to me is it's just a rule of thumb. And I would say something similar about the 60-40 portfolio. Like if I was to go through all our clients' portfolios right now, there's probably like nobody who's actually 60-40 exactly. Like it's something we look at. It's something that's a benchmark, but it's not really, you don't like come into your investment advisor with like, all right, let's get your 60-40 ready for you. Like there's people do so many different things besides that. So it's great to look at it. It's great to track it. It's great to talk about if it's dead. But in the real world, like most people are not invested in the 60-40 portfolio.
Not in the traditional, like all I own is an S&P 500 index fund and all I own is the ag or something like that. Or all I own is like 10-year treasuries. Very few people are invested in it as the true benchmark version of the 60-40 that we talk about. There's a bajillion variations. And a lot of people have that, and they might shade up or down a little bit or a lot of it in various directions. And that's the real reality of portfolio construction.
So let's just talk at a high level. The basic idea here is for 40 years, we saw a certain type of market environment. We saw a market environment where we didn't have high inflation. Most of the shocks we got were recessionary shocks. Bonds are great performers in recessionary shocks. But if you look at the full history of the market, there's been a lot more inflation than that. And during these inflationary periods, stocks and bonds can struggle together. And so you can argue if you want to protect yourself, if you think about that whole thing about the different quadrants that can happen in the economy, if you want to protect yourself in all of the various quadrants, you have a big opening if you have just stocks and bonds with this inflationary shock type thing. And if you want to protect from that, you need something else. So that's the general idea behind this. Now, what I also will say, and we've said this in every episode we've ever done about the 60-40 portfolio, is the 60-40 portfolio is not dead. The 60-40 portfolio will probably work just fine, and for the Rick Ferry type investor who's just going to put their money away and not really worry about it and not really worry about 2022 and get their risk premiums on stocks and their risk premium on bonds, and they're going to probably do fine over the long term. So although there will be this area that, is a weakness in there, and that area could drag on for a long period of time. I mean, in this case, it wasn't that long of a period of time, but we could be in for a longer period of inflation. It's an area of weakness, but for a long-term investor who truly doesn't care, who's got their stocks and their bonds, it's probably fine to be in that. So I think there's a clear weakness in that portfolio, but I also don't think it's dead. And I think it's important to acknowledge that before we start.
It's a rule of thumb, like you said before. I always think of the great Dead Kennedy's quote, "Punk's not dead, it just deserves to die." I feel like this about the 60-40, the myth of the 60-40 as the great ultimate portfolio kind of deserves to die. We have to be able to talk about it with nuance. The reality is when we look back in that 40-year history, 1974 up until I want to say the beginning of this year or last year, the index, Bloomberg US Aggregate Bond Index, negative 4 times in, almost 50 years, like 4 negative times in a 50-year period. Of course, something that contains 40% of that is going to put up good numbers. Once in a while, you get these shocks where the thing that you expect doesn't happen. And it's more than just like a tail event. This is something that does happen. You have to plan for it. You have to think about it a bit more broadly. And that's where it's useful to have these conversations and try to shake through these details.
Yeah, and when you think about a diversifying asset, what you just said is what you want in a diversifying asset. You want it to not be down often, and you want it to be there when you need it. And that's basically what bonds were for that entire period. When you needed bonds in 2008, you were pretty happy you had the bonds. They did what they were supposed to do. The problem is bonds are not always there when you need them. In certain types of shocks, like we saw in 2022, bonds are not there when you need them, and bonds can go down more than they had during the rest of that period. So it's just understanding that type of environment can exist. And I'm not, you or me is not going to predict whether we're going to have a spike back up in inflation or whether it's coming back down to the Fed's target. I mean, we don't know that. But it's certainly possible it's not going to come back down to the Fed's target, and we're going to get more bouts of inflation. In our previous episode with the charts, we had done this. You had that bond and stock correlation chart you put in there, and we were talking about the periods where bonds and stocks were positively correlated. And Like after not having zero of them for a long period of time, we had like three of them, in a pretty short order. So it's at least an environment where we're starting to see that more and more. And so you may need something beyond this. You may not need it. But I think the key, and as we'll get into here in a second, is to find a systematic way or to find a process in terms of how you're getting it.
From a financial planning perspective, I know for me in the profession, these last few years have been a real eye-opener about just how seriously you have to take this stuff. Because when we're thinking about not just sequence of returns, but sequences of contributions and withdrawals as they stack over returns, when you have that in 2022, you don't just have the down year for quote unquote bonds. You have a 5-year flat or slightly negative number in many cases. And whether we're thinking about rebalancing, whether we're thinking about sustainable withdrawal rates, whether we're thinking about all this in the context of diversification, the reality is that simple stock bond portfolio, if it's just the two things, you don't have anything else. Further diversification into subcategories can really be the make or break thing in the real world with real portfolios that people are either making regular contributions into and trying to save for themselves, their families, next generations, whatever, or very, very importantly, when you're taking money out of those portfolios that you depend on to live on. Because we saw in the last few years, the diversifying element not exactly do the thing you wanted it to do. And if you have even just one other option in that environment, it can make a tremendous difference in your experience.
Yeah, this is so important because I was actually a little bit wrong in what I said before about like the 60-40 portfolio is going to be fine no matter what. And the one scenario where you do have an issue there is if you're retiring in 2022.
Exactly.
And when you have withdrawals, a lot of these other portfolios we're going to look at, one of the advantages is they have less drawdowns and they have more consistent returns because they're dealing with all the different economic outcomes. And if you retired in 2022, and I don't know what the 60-40 was down. It was down a lot though. It was one of the biggest
in the
declines in
teens.
history.
Yeah.
Yeah.
In the teens, double digits.
If you were pulling out, a significant amount of money, now you've got the problem is the money can't grow. You've got sequence risk kicking in there. So I think that is important. And that's one of the advantages of these more total return, all economic environment, all weather type strategies is they do have lower drawdowns. And so they can lead to higher sustainable withdrawal rates. And they also can help to minimize sequence risk if you happen to retire at the wrong time, because sequence risk of stocks is something people talk about a ton, but they didn't really talk about sequence risk of stocks and bonds combined for a really long period of time because bonds were always helping the stocks. So bonds were always helping you with that sequence risk problem. But in the case of 2022, they did not help you with the sequence risk problem. And that's where some of this other stuff we're going to talk about can be an advantage.
It's a huge deal because, and think about it, I'm grateful that in the earlier part of my career, coming in like the financial crisis type era when I started doing planning full-time professionally, we had that 2000 to 2010-ish period, the lost decade in stocks. And one of the great lessons in that is you had several upswings where you had positive sequence of returns for stocks. You had some great opportunities to rebalance, whatever else, but you had those tremendous drawdowns. And we saw what bonds did over that full period of time. Cash got you a modestly positive return. So that's even if you're just stocks, bonds, and cash in a portfolio, you could have retired into something if you had enough cash. But bonds, I want to say in that window, that 10-year lost decade for stocks, they put up respectable returns. You got your 5, 6, 7% or whatever. And that is a diversifying element of helping zig when something else zags, of helping you plan for the combined sequence of returns risk, especially when you need a distribution strategy with the flexibility, ideally, which is a lot of the work we do with clients, to kind of like pick and choose. So in this environment, when this happens, in a year like a 2022, stocks and bonds both get punched in the face. What alternatives did you have on the table, be it cash or something else, where you go, I can let that recover, but this is going to get me through a multi-year period. Also why the 2022 5-year number for fixed income was so terrifying, because it's like, hey, we're used to seeing stocks have a 5-year period where they can take a good while to get back to break even and above. To see that happen in bonds too, it's just a reminder, there's no perfect hedge, especially when you need that money.
Yeah, so thinking about some practical ways you can deal with this, in one way you can do it is you can just have fixed allocations to other asset classes that do well in the periods where stocks and bonds do poorly. And the best example of this is the permanent portfolio you see a lot, which is basically 25% short-term bonds, 25% long-term bonds, 25% gold, 25% stocks. And so if you think about the quadrants, high inflation, low inflation, high economic growth, low economic growth, if you think about each one of those 4 quadrants, you've got an asset in the permanent portfolio that should do well in any of those quadrants. And gold is your asset you're adding in to basically deal with the inflationary quadrant, which is your weakness with the stock and bond portfolio. So the permanent portfolio is an interesting portfolio. I mean, I think it has decent returns over time. It has significantly lower drawdowns than a 60-40 portfolio. It actually had one of its biggest drawdowns in 2022 as well, although it was significantly less than the 60-40 because gold didn't do as well as people had hoped in 2022. So you could argue maybe that's a different thing you could use there, but gold is what they use for the inflation hedge. But yeah, that's a more consistent return portfolio. Obviously when stocks are ripping, you're not going to be happy you hold it. And as we've talked about on the podcast before, in the beginning of 2009, when we just had a massive bear market, enormous amounts of assets are going to flow into the permanent portfolio because the permanent portfolio wasn't even down in 2008 because the other things, the bonds, the gold offset what happened in the stocks. And basically I think it was like a slight positive to slight negative return, depending on how you did it. So, you think about that when the market was down 50%, people are pretty happy about that. Unfortunately, they put all the assets in and then that was a huge bull market run. So going back to our point before, you've got to hold these things long-term. But yeah, I think the permanent portfolio is an interesting strategy. And going back to retirement planning, which we talked about before, it can actually be good for withdrawal rates too, because it is pretty consistent in terms of the returns it produces.
We'll get into it. We actually have like a 4 segmented buckets approach that sort of like helps us understand this when we do this. The one thing I want to say about the permanent portfolio is Harry Brown, I want to say 1981 is when it's formally introduced, right after what? A giant inflationary period in the history. So we see these things over and over just get introduced with some really well-informed rear view mirror. And in a case like the permanent portfolio, just like the 60-40, there's some good underlying intuitive sense to why it does what it does. And we can step back and study those broader reference classes. But they're all going to be like optimized out of some specific period of history where it's when these things are happening, this works really well. And then you're trying to say when those things aren't happening, how bad does it get? That's the learned experience here with all these things. But I do think the permanent portfolio at least gives you, if you're spending money, I now have 4 different categorizations of things I can take money out on times that I need to take money out of. And that's not a bad starting position if you're trying to figure out how to spend money in retirement.
Yeah, so the next level beyond the permanent portfolio is what they call risk parity. And so the idea is, like, for a lot of people who invest in these, who build these multi-asset portfolios, they're trying to achieve 2 different things. One is diversification and the second is balance. The permanent portfolio achieves the diversification. It goes beyond stocks and bonds. It closes that inflationary problem that exists in a 60-40 portfolio. It does not achieve balance. And what they mean by balance is basically you want each of the assets to basically contribute an equal amount of risk to your portfolio. So if you think about the permanent portfolio, it's got 25% in short-term bonds, it's got 25% in stocks. It has equal weights in there, but stocks are contributing way more risk to the portfolio than short-term bonds are. So what you can do with risk parity is you can use leverage to lever up things, and you can basically get to a point where each asset in the portfolio, and these typically go definitely beyond stocks and bonds, commodities, sometimes currencies, all kinds of stuff. You lever those things up so that they're achieving balance. They're each contributing an equal amount of risk to the portfolio, and then over time you keep adjusting that as things go on. So it's a more advanced strategy, but it is available now in ETF form. It was not available in ETF form, and we'll talk about a lot of things we'll talk about today are sort of newly available in the last few years in ETF form. So it is out there. It's something you want to understand if you invest in it. But it's kind of a cool thing. I mean, it really is. You're really thinking about all the different potential economic outcomes, and you're trying to build a robust portfolio that can stand up to all of it. And you're also saying, like, I don't want stocks to contribute like way more risk to my portfolio than everything else. I want to achieve a balance here. Adam Butler always says you want like each of your assets to express their personalities. And so that's what it allows it to do. Like your short-term bonds or whatever, which contribute almost no risk to your portfolio, like you allow your bonds to express more of their personality. So I think it's a cool, interesting strategy, and it fits into the permanent portfolio in that it's more of a static allocation type thing. We're not like rotating between asset classes or anything. It's sort of a set it and forget it, although it does change over time. It's like a static allocation type portfolio across multiple asset classes.
And I think anytime we talk about the really cool thing about risk parity or anything that's volatility targeting, and let's just say this too, risk parity. Risk here means volatility, risk means variance. And that means instead of just looking at the mix of stock relative to bond, we're taking a step back and saying, no, I actually want to look at stock volatility, stock variance, compared to my bond variance and whatever else you want to slap into that portfolio. I can now take that and have a volatility target, which is a little bit different than like mean variance optimization and like where we get out of the 60/40. So the math and the approach is just different. It's a similar construct. And then there's lots of ways you can scale that. You can scale that with leverage. You can do a version of it kind of without leverage. You can do all sorts of interesting things if you start doing portfolio construction from the perspective of volatility targeting or return targeting or whatever else versus just looking for mean variance optimization. I'm probably getting some of those words wrong. Somebody in the comments is going to hate me for all these things, but these approaches and working through all of them is an insanely useful exercise for a professional and an interested person to do at least once in their career.
I like that you're throwing around all the terms here. You're getting aggressive, and I like it.
Yeah. Too much coffee on a Friday afternoon, and it's finally not 95 degrees here. So, let's run the whimsy.
The other thing that's important that I missed that you picked up on is this vol targeting thing, because it's important to talk about that because there is not just a risk parity. Like with permanent portfolio, you've got your allocation across the stuff. Like risk parity can be run at various levels of volatility.
Oh, yeah.
And so like just one person's risk parity portfolio is not another person's risk parity portfolio. So if you see one from one provider and you see one from another provider, you've got to understand what's going on behind the scenes, which is why it's good for people who are a little more sophisticated or have an advisor or something, because you can lever up risk parity a lot. And you could run it at really high levels of volatility, or you could run it at lower levels of volatility, and they'll produce very different outcomes for people.
Yeah, and because you're chasing volatility, the volatility profile, you're rebalancing, these things change over time, and they create issues. There's lots of market dynamic issues and things where, like, when the commentators on TV blame risk parity, and it's like, well, there's 80 flavors of this, but when we think about volatility targeting, and we think about stuff going up or down, or volatility changing in different markets, yeah, it causes people to rush into one thing and maybe rush out of another. And you have to have an understanding for that because there's a lot of flavors of ice cream at that ice cream shop.
Yeah, so the idea, and then to your point about this, the market commentators are almost always wrong when they blame risk parity for anything.
Oh yeah, that's a great boogeyman. Great boogeyman.
But the general idea is if you're weighting things based on volatility, if something significantly changes with the volatility of a certain asset, because you're using a look back period to say, like, what was the volatility in this look back period? If something significantly changes and a certain asset has higher volatility, now I've got to sell the asset to keep in balance again. So that's what they're talking about on TV when they say that, but half the time they're wrong and they have no idea who's actually causing the market sell-off or whatever they're blaming it on.
Yeah, and the wacky thing here is usually volatility's gone up. That means the price has gone down. Usually isn't happening the other way around. So the thing is like, oh, why did this thing go down so much in a single day more than normal? You got multi standard deviation moves depending on all your timeframes and measurements. But it's this idea of vol went up, the price went down, it went down an extra. It must be risk parity selling because the vol profile said rebalance away from this thing because vol increased. Who knows?
So the other one I want to touch on before we talk about what we do is return stacking, because I think that's a really interesting concept, and it's kind of a middle ground between like risk parity and what you would consider like a traditional 60/40 portfolio. And this is from Corey Hofstein and the guys at Resolve. And they wrote a great paper about this. They've launched a bunch of ETFs. So they've expanded this concept a lot since they originally came up with it. And I'm just going to talk about what they originally were talking about. But the general idea is this, like through leverage, I could basically use less than all of my money and I could create 100% exposure to the 60/40 portfolio. So like the Wisdom Tree still has, before the return stacking guys launched their own ETFs, they had like a 1.5 times, stock and bond ETF. And basically the idea was I could put 67% of my money in that 1.5 times stock and bond ETF, and I could get the return of the 60/40 portfolio. Now, what do I have now? Now I'm sitting on 33% of my money that's not invested in anything. And so I could put that 33% in something else to enhance my returns. So Matt, the obvious thing for me to put it in, I think, is crypto. I'm just kidding.
Crypto, South Florida real estate. I mean,
right.
Let's get crazy here.
But I'm giving that example because it's an example of exactly what not to do. So the idea is you're using this leverage to get the return of the 60/40 portfolio. What I want to do with the other 33% is put it in something uncorrelated to the 60/40 portfolio. I don't want to put it in like small cap value stocks or crypto or something, because then I'm opening myself up to a catastrophe, when we get a market downturn. What I'm trying to do is put something in there that maybe goes up or down opposite of stocks and bonds. Again, some of these inflationary type things are good. Or even in the situation we're in right now, T-bills pay 5% now or something, some sort of risk-free short-term asset, you can add that onto your return. Because the idea is when I'm doing it this way, I'm using the 67% of my money to get the return of stocks and bonds. So whatever I do in that 33 is additive. They call it like on top. it adds to my return. So if I put it in T-bills, whatever T-bills are paying times, the 33% I've invested, that gets added to my return over time. So the idea is it creates a more, what they'll call a capital efficient portfolio. And, people get scared of the term leverage, and, to some degree they should be, but when you do it properly, when you use leverage to invest in things that are uncorrelated, it can make sense. And the big advantage of this relative to something like risk parity is you're getting your 60-40 portfolio return. So behaviorally, it's much easier. Risk parity strategies can look very, very different than stocks. They can look very, very different than stocks and bonds. They can have many years, as we've seen, where they lag those types of things, and then they can have years where they're a lot better. And a lot of people just can't deal with that behaviorally. So Corey and the guys at Resolve, their idea was here, if we deliver the stock and bond return, and then we put this other stuff on top of it, now we're creating a much better behavioral situation where people are more likely to stick with this than they would be like a standard risk parity strategy.
I think that last point of return stacking, in the same way that like risk parity is going to take the idea of volatility or variance to come up with this thing, return stacking is just a novel approach to sort of reframe a lot of the similar math. You tell me if I'm mischaracterizing this, but it's informed by a lot of the same math. It's informed by a lot of the same thinking. It's a novel approach, and it makes a lot of sense for a lot of people, as their fund flows can attest.
So we'll talk a little bit about how we do it now. I'm going to go first, and then you can talk about kind of what you guys do at SunPoint. But at Validea, we're quantitative managers. So we were looking at this problem of we want to do something different than the 60-40 portfolio, and we're saying, like, how can we tackle that problem quantitatively? So I need some sort of factor, just like I use in our equity portfolios. I need some sort of factor to help me do this. And there's really one factor in this use that rises above all the other ones. I mean, I could sit here and, parse economic data and try to figure out whether we're in an inflationary environment and figure out what to put in there. It's just, if you test that kind of stuff, it just doesn't work. It's very, very hard to do. I mean, there may be guys that are better than me at it that could do it, but we couldn't do it. So the one factor that really works well here is momentum, because they always say price is true. Momentum works across pretty much anything. AQR had a paper around that, where they showed like momentum pretty much works across everything.
Value and momentum everywhere. Classic paper.
I think it was, yeah. It was
classic,
exactly.
yeah.
Yeah. So anyway, the idea is, like, if we want to be able to change these exposures, if we agree with the fact that, commodities may not be something we just want to put away and hold forever, we may want to use momentum to distinguish those things. So that's one of the things we do. And I'm going to get in a second as to how we do that. But the other thing we wanted to do is we wanted to have kind of, especially because you deal with a lot of people who have taxable accounts, and some of the turnover with momentum is not what you want. So we also wanted to enhance the permanent portfolio. We wanted to have more of a static, at least a more static allocation. And so what we did is we looked at the permanent portfolio and we tested it, adding some things to it. What's interesting about the adding stuff to the permanent portfolio is there really is one thing you can add to it, which is not technically per se an asset class, but it adds to it. It's a clear winner when you look at it in testing in terms of what it adds to the permanent portfolio. And that's managed futures. And for a long period of time, managed futures were not something you could get in an ETF, but now it's something you can get in a lot of different ETFs. There's tons of people running different, nuanced managed future strategies. And the great thing about managed futures, there's two really good things about managed futures. One is it avoids what you were saying about what bonds did during the 40-year period. Managed futures does it over a much longer period of time, which is it generally avoids major losses, and it also is there when you need it. I mean, your typical managed future strategy was up a lot, like in 2022. So it provides a great diversifying source to those other things in the permanent portfolio. And it's not per se an asset class, it's a strategy. But when you test it, you get a superior portfolio to just the other four asset classes. So we effectively add managed futures as a fifth asset class to our permanent portfolio, and we offer that. And then the only other little enhancement we've done around the edges is one of the cool things is you're seeing so many of these innovative ETFs that do, and we're going to talk more about that when we talk about Nomadic Samuel stuff, but there's so many ETFs that are doing things that you just hadn't seen ETFs do before. And, we're not going to give tax advice here, and we're not going to say, what's going to change in the future. But right now, what our friends Alpha Architect have launched with the box ETF is that they've launched a way to get a return comparable to the risk-free rate, but to do it in a more tax-efficient manner. And so we felt like for our version of the permanent portfolio, that's a better thing than short-term bonds. And so we've replaced short-term bonds with that. And so that's a lot of the stuff you can do with these permanent portfolio type things. Like around the edges, you can think about how can I make this a little bit better while maintaining the general idea of I want this total return type portfolio. I want something that's not, exposed to inflation in the way stocks and bonds are. And so that's just in the real world some ways we've thought about it. And we're also thinking about, there's some cool tail risk ETFs that have come out. Tail risk is traditionally a problematic area because it just bleeds away your returns over time. But there's some more innovative ETFs that have come out that have figured out ways to maybe minimize that at least. And tail risk is another thing that's great as a diversifying asset because, and we'll get into this also with Nomadic Samuel stuff, but tail risk is something that, when you have the major market blow up, like a small allocation to tail risk can make a big difference in terms of making your returns more consistent, as long as you can minimize the bleed during all the other times where you're not getting these major market events. So that's something we haven't done yet, but we're looking at. So that's sort of how we think about the permanent portfolio. We think about starting with the more standard Harry Brown thing and some of the enhancements we've made over time to it.
And is it, for you guys, is that 5 parts equal weighted still, or is there a different rubric for how you solve for the weighted?
Yeah, that's how we're doing it right now, yeah. We played with some different things. We played with, we wanted the growth of stocks, so we did play with keeping the stock allocation higher and putting the other stuff lower. But right now we do. I mean, when we looked at the risk and return of this, and if we look at what we're trying to accomplish for clients with this, because typically for our clients, it's always paired with some sort of equity strategy. You've got your permanent portfolio allocation, then you've got your equity allocation. So we're not typically running too many people as like 100% in this. So a lot of people are getting their growth side of it from like a different portfolio. So for us, for our specific use of it, that made the most sense. And also for us, for our specific use of it, you can get managed future strategies that use all assets, and you can also get ones that don't use stocks and bonds.
Right.
And we went with that. We went with the second one. We thought for our use of it, like managed futures that were not focusing on the same asset classes we already had in there was a good thing. And we talked to Eric Crittenden about this, and there's pros and cons that are people like Eric Crittenden who use 7-syllable words who are much smarter than me can tell you about. But that's what we decided to do.
You just wanted to know you owned cocoa beans or something, or orange juice futures at some point, right?
We wanted cocoa, yeah. I think the cocoa thing fell apart, didn't it? It was a massive run, but I think it did come to an end.
I think it did finally end, but that was a couple of weeks or months there where all we heard about was how good those cocoa beans were doing.
And it is an advantage of these types of strategies. You are getting exposure to some things that you probably would never get exposure to. Like none of our clients have ever considered like a direct allocation to cocoa. So like if you're doing it
yourself, man.
Yeah, exactly. That has a massive allocation to cocoa. But the nature of the long-short nature of managed futures is so important because that's how you get the consistent returns. And, they're just, whatever's going up, they're buying that. Whatever's going down, they're shorting that. And it's a good complement because it's just very different than these other long-only asset classes that you can invest in.
It's useful. And again, it's one of those things where you have to have the framework. One other question for you on this. How do you think about the balancing between the two? What's enough of an allocation to this next year growth strategy in your perspective, to the degree you can answer this? Like what's enough versus what's not enough?
Well, it's a really good question. It's, to be honest, we are all over the map on this because it's so specific to the individual we're managing money for. I mean, we have people who have most of their money in this and a small allocation to more of an equity type portfolio. And we have people who are the exact opposite way. We have this as a balance. Like we have some systems internally where we can test this and look internally. Like we'll think about like who this person is, what sort of volatility they're looking at, what kind of returns they need. We'll look at all that stuff and we'll figure it out. But the answer is in the real world, there's really no good answer because we're all over the place. And you do have to keep in mind with something like this does have equities in it. So when you're thinking about balancing it with an equity portfolio, you have to add the equities in this to the other equities to really get your equity exposure. And that's something we always keep in mind when we do this, is this is not like an equity-free portfolio. This is a portfolio that has some equity. And when you're coupling it with another portfolio, you have to keep that in mind.
This gets to the core of, and I know we've talked about this in other episodes too, if you're going to have alternatives, what's the minimum amount you have to have for it to make a difference? And that's one other thing that I think I see less of as I don't want to call it a mistake. It's just one of those, how'd you end up with this thing? Where it's somebody has something that's actually a diversifying element, but then they have a 2% stake to it. It's like, this isn't actually going to help you the way you want it to help you if this is all you own. You can't have the cocoa allocation, but it's just you have some Hershey syrup in the refrigerator or whatever. It's like you have to have a meaningful enough amount to make a difference in a portfolio. And as we get into these diversifiers, these other elements beyond the 60-40, a philosophy behind this too really, really makes a huge difference.
Yeah, and to your point, we're not typically putting like 10% in this portfolio because if you think about it, if you put 10% in this portfolio, you've got 2% in each of the sub things within the portfolio. Like, is that really making any difference? Is that really going to help you when you need it? So you've got to, because it has all the different assets underneath it, you've got to scale this more than that, definitely, for it to make any kind of difference. So it doesn't start that low, but yeah, it really is dependent on, and this new strategy we'll talk about next is something we also tend to blend with this. So yeah, it really depends on each individual person, but it's not, to your point is a really good one, which is for this stuff to matter, like you can't just go put like this really crazy small allocation to this thing and have it make any difference.
Yeah, rules of homeopathy don't apply to this. The infinitesimal dose.
You're breaking out the words today.
I am. This is
you like I don't know what you drank. Something's going on over there. I have to hire you to our quant team soon.
Hire me the quant team. I'll bring all my cocoa beans over. So the when we look at this, and again, it's interesting hearing you talk about the Validea approach to this, because it's when we look at for SunPoint, we basically divide everything up into, first, you're either a risky asset or you're a risk mitigation asset. And that division for us is kind of like, that's your starting principle is your role in the portfolio, in the financial plan, and whatever this is doing, to actually take risk and grow, or is your role to be there as a stabilizer of some form in the broader portfolio? This tends to
think about it like as relative, when you think about risk mitigation assets, is it like relative to stocks? So for instance, gold is a risky asset, but also a risk mitigation asset. Like, how do you think about that?
Yeah. So what's interesting is, so we start with like risky and risk mitigation to put them next to each other. But then as we drill into each, and this is how we start to get into like different vehicles, different managers, different asset classes and selections. So under risk mitigation, like the safest thing is what we define as defensive. And this is where you see cash, short-term, high-quality bonds, stuff where basically low volatility is inherent to the vehicle. That doesn't mean you couldn't have a 0% yielding, T-bill or something, and all of a sudden inflation spikes and it's down to negative real return sense. But at least relative to your growthy assets, this should be like really, really stable. It's the money in the coffee can in the backyard, and up to something that's bearing a tiny bit of interest with the full faith and credit of, like the U.S. government behind it. As soon as you step off of that, still under risk mitigation, we have what we call the flexible assets. And I kind of think of that, it's the vehicle plus another element. So this is where we start to add credit risk in. This is where we start to add, to a degree, like ultra short duration private credit could start to fall into these things. We start to get into categories where you are definitely not defensive, but you are risk mitigating against the growth in the whole portfolio. And lots of stuff can fall into that. Like you could have unlevered merger arb. You could have lots of private type of strategies that fit into this type of vehicle that start to look quirky depending on the bigger the asset allocation, the bigger the amount of assets usually for the client. When we move into risky assets, the next click up on the curve is basically hybrid and income, which could be income and hybrid too. Actually, sometimes think they belong in the other direction, but we say hybrid income just because it fits together nicely. Hybrid and income are basically where anything that's still not quite a growth asset, but is definitely no longer a risk mitigation asset, starts to fit in. So this is where you might find gold, to your example. Gold, depending too, is it a passive holding or is it something that's being actively traded in a strategy? That can play into this as well. A lot of our hedge funds, a lot of private equity, a lot of stuff that's a vehicle where basically a component of the total return is based on some type of like income, and that income component is also variable. That's what lands stuff into this hybrid income category. And then last click up, we get into growth. Growth skews all the way out to that right tail as well here. So it's everything from your public stock investments. It's everything from if you had a really dialed up on volatility risk parity strategy, that could fit here. If you have levered equities, that could fit here. Venture capital, more aggressive private equity strategies, things like that, they're going to fit in this growth bucket. The usefulness of, again, this absorbing all the way back up into risky assets versus risk mitigation is we can start to tag what everything is when a client comes to us with a portfolio, or when we're building something out for another client, and saying we can kind of categorize everything and how we think about critically how it relates to everything else in the portfolio. Just having a rubric for that, it's so important for a professional in our space.
Yeah, it's cool to listen to that because you and I come at this from very different places. Like you're doing a financial plan for somebody, And we do a little bit of that, but not to the level you do it. Like you're really thinking about this at a very high level and bringing all this stuff in. And I'm actually building like real world, strategies that are rotating among things. So it's a good balance to think about this because I think both of those mindsets help when you're thinking about this type of thing.
Yeah, and they help when you're communicating it to people too, because clients come to us with different understandings of these things. Having a rubric to help decide, especially in our world where we're leaning a lot into people need money for consumption or people need money to cover things over a specific time frame. There's the liability driven approach that we've talked a lot about on this podcast in the past, where we're actually saying, and it might be the money that I need to withdraw from in retirement and going, do I have enough in my, not only in my risk mitigation assets, but how much is in my defensive assets that I can draw on so that when bonds do go down for that 5-year period in a row, did I have enough in defensive? Do I need just a little bit in flexibility in my flexible assets? And do I want to minimize my growth assets in that scenario because of the timetable I'm doing this? Or is it we're trying to give G2 or G3 these assets in the future? So it might be a real estate portfolio that's intended to be a little bit more growth on the growth side, but there's a real like hybrid income component in there too, where I'm going, well, it's not going to be as volatile because of where it is. The people pay rent. The income gets absorbed into the vehicle and gets reinvested for this period of time. But at this point in the future, it's going to start to kick off money to these family members. And at this point in the future, we expect it could either be liquidated or turned over. That calendar impact to how these things play out over time. We need these vehicles. We need this rubric. We need this index to map all these subcomponent parts on to make sense of it. Because if we didn't have that, we'd just be shooting from the hip.
Yeah, and going back to the momentum thing I talked about before, like that's the other way, we will tend to look at this sometimes is how do I don't have a fixed allocation. I want to rotate among assets. How do I do it? And it's surprising. There's a lot of academic research around this. There's a lot of papers that have been written about various strategies you can use to allocate to assets using momentum. And so I'll just highlight a couple of them, but our general approach to this is what you and I have probably, people who listen to us all the time are probably bored about this, but what we always talk about, which is we're always blending stuff. If you don't know what the right thing is going to be, blend it. And so what we try to do is find a bunch of different asset allocation strategies that use momentum to allocate among assets and then just put them all together into one thing. And so that limits the risk that you pick the wrong one, but it also reduces turnover because there'll be times where one is selling and one is buying. And so if you kind of put the whole thing together into like this mesh, then you end up reducing turnover a little bit as well. But just to give an example of how we do it, and anyone can Google these names and you'll see like extensive papers around this, but like one of the things we use is called protective asset allocation. And this gets at the idea we've been talking about, which is it takes 12 different asset classes, which is basically your US stocks and bonds, the NASDAQ 100 in the US, European equities, Japanese equities, emerging market equities, commodities, gold, real estate. It takes ETFs that cover all these areas. And it basically invests out of the 12 in the 6 that have the highest momentum. But the catch to it is if ever more than as those assets start to end up being in downtrends, those individual 12 assets I said, you start to raise cash and you start to go to what's called the crash protection asset, which is either intermediate term bonds or short term bonds, depending on which one of those has the most momentum. And so the idea is you're investing in this really diversified group of assets, but as those assets, more and more of those assets go into a downtrend, probably something, because they are a diverse group of assets, probably something's going on in the markets that's more of like a crash type event. And so what we're doing is we're raising cash. And then if more than half of those assets are in a downtrend, we're sitting in cash. So it's like a combination of this momentum approach to buy a diversified group of assets, to buy the ones with the most momentum within there. And then this crash protection thing that says, get me out of these, if something's going horribly wrong. And there's another one called generalized protective momentum, which is like the cousin to this. And the big difference between the two, the generalized protective momentum buys 3 assets instead of 6. But the general idea, the big difference is correlation. So generalized protective momentum is not just using momentum to determine what assets to get into. It's also using how correlated they are with each other. And so that can be a way to reduce drawdowns, because if I'm not just buying the assets, if I'm buying just the assets with the most momentum, I could be in, all in like equity ETFs at a given time. If I'm also taking correlation into account, now I'm probably less likely to be all in equity assets. I'm likely to have something else in there, that's not as correlated with equity. So that's the general idea, is we just have a bunch of these different momentum type approaches. We blend them all together into like an overall portfolio for clients.
The idea that these things aren't static, that these things can be dynamic, is, I think, really important to discuss with people who don't allocate, or they have one strategy that they deploy, or they're just not used. We see a lot of variance on this across the industry. I work with a lot of financial professionals too, where it's like, oh, I'm a fund manager, or oh, I'm working at this PE firm, or oh, whatever. And it's like, this is how you zoom out and you think about, this is not a static approach. This is a dynamic approach to asset allocation and your portfolio and what you need the portfolio to do. And then whether you're overlaying momentum, you're overlaying valuation, we tend to overlay both, at least in trying to understand what we are, and have like kind of like a map for how we dial these things up and down. Because something else that this is my broken record version of your broken record thing is my broken record is this stuff just keeps changing all the time. So you need to have a framework to actually be taking in what's going on right now in the real world and going, if I'm getting above average results, how do I temper that optimism? If I'm getting below average results, how do I actually boost up the optimism that inherently has me running in the other direction? And how do I just have a framework so I can repeatably make these behaviors and not just be shooting from the hip?
Yeah, your dynamic versus static thing is important to keep in mind too in taxable accounts, because obviously anything that's dynamic has the potential to be not as good from a tax perspective. And so it's important to keep that in mind, because that's why we do both of them. And you really want to have both of those types of things depending on who you're dealing with, the situation, a lot of other things. And so we have both, but definitely if you're making changes, there's the potential for tax implications of that. So that's something to keep in mind with any dynamic approach.
It's always an active decision. You can be as passive as you want in the vehicles. You can own that 60-40 with 2 Vanguard funds and call it a day. But as soon as you're adding money or taking money out, it's an active decision. Just understanding this stuff can go a long way to giving you a philosophy around it. I think that's why it's so important.
So the last thing I want to look at before we close it out here is this Nomadic Samuel stuff, because it's really, really cool. The site is pictureperfectportfolios.com. And
really cool and really friggin' intense. Like, this is one of those
really
things.
Intense. Yeah, no, it's like
when somebody says, have you checked out Nomadic Samuel? And if the answer is no, and then you go in, baby Jessica, welcome to the bottom of the well. This is some stuff.
What's cool about him too is he's really a travel blogger. I mean, that's his usual thing. Like, he's not an investing guy by trade. And he has YouTube channels that have hundreds of thousands, if not millions, I don't even know, a lot of followers on the travel side, for all the stuff he's doing there, which is really cool to watch as well. But what he's done here is really cool, because what he figured out is, with all of these new ETFs funds that are available, there's some really cool things you can do in terms of trying to build these consistent total return type portfolios. And, we've talked about some basic things like, managed futures ETFs, but the reality is there are a lot. Like, whenever I go to his site, I'm like, there's an ETF that does that. I didn't even know that existed. Like, there's so many of these ETFs, and a lot of them use leverage. And so obviously you have to be careful with that, but there's so many unique and cool ways these can be combined to put into portfolios that can be like these total return portfolios. And going back to the Ray Dalio idea, like, you want uncorrelated return streams, like as many as you can get. And that's very hard in the real world, because most things are correlated. A lot of the return streams are tied to the same thing. Like, stocks and bonds are a good example. Like, they can be uncorrelated return streams at times, but they can also be correlated return streams at times. So, like, he does a really good job of finding these things. And we'll talk about one of the portfolios just as an example, but of finding these things that can be put together into, like, these uncorrelated core return streams that can be combined together into these total return type portfolios. And he's able to, obviously we have to, any back testing done by me or anybody else, you always have to say the past can, the future can be different than the past. It's part of the deal. But the tests on these are really, really cool in terms of like the risk and return stats that you can come up with.
So I'm just curious, have you independently worked through any of this stuff on your own? This is one of those where I look at this and I'm fascinated by it, both empirically and academically, but I haven't done any of the work myself to really like vet these aside from the logic check in my mind.
Some of them. Yeah. And one thing to point out with his site is there are a lot of portfolios on there.
A lot.
We're just going to go through one example just because I thought it'd be cool. Not because I've picked this because it's better than anything else he's done. It's just because
you're recommending this completely and your entire network. Okay.
But it's very, very cool to like see the types of things that go in here and like the thought process behind him. And I can't explain it as well as he can. And I hope someday he'll come on Excess Returns. We'd love to interview him about this. But it's just the idea of how you do this. And so he has many, many portfolios for many, many different goals. And there's no right way to do this. I mean, there's various levels of risk. There's various levels of drawdowns you can live with. But just the fact that you can combine stuff to produce some of these stats, and we'll put up like one of his, I think he ran these numbers on Portfolio Visualizer which is not there anymore, or at least is not there in the form where you can do this anymore. But there's a new site that does allow you to do this. And so you can go back and you can test these ETFs, and you can also, a lot of these ETFs either had like predecessors that were mutual funds, or they have mutual funds that run a very similar strategy. So for example, like there weren't managed futures ETFs for that long, but there have been managed futures mutual funds for a much longer period of time. So you can test further back. But even at that, I mean, you're testing, I mean, I think this one here, he tested, I believe, to 2014. So you're certainly not testing to 1928 or whatever when you're running these types of strategies, because these are just things where there's not data, going back that far. So you have to always take that with a grain of salt. But let's just look at it because it's an interesting, so this is one we're going to throw up on the screen. It's called the Fortress portfolio. And what it is 20% USML, which is 2 times leveraged min vol, 40% RSBT, which is what we talked about before, the return stacking guys, Corey Hofstein and the guys at Resolve, return stack bonds and managed futures. So that's a leveraged bonds and managed futures strategy. Then BTAL, which is basically an anti-beta fund. And then CAOS, which is Alpha Architects Tail Risk Fund. We talked about something similar to that before. Then Style Premia Fund, and then Gold. So these are like very, very different strategies that are all being combined together. And then this is what it ends up with in terms of an exposure: 40% min vol equities, 40% bonds, 40% futures trend, 10% market neutral anti-beta, 10% out of the money puts, 10% style premia, and 10% gold. So there's a lot to that, but the general idea, and we won't go through each individual one and like what it all means and stuff, but the general idea is you've got these uncorrelated return streams and you're putting them together, and you're doing all of this through ETFs, which 5 years ago, 10 years ago, whatever, like this was not possible. Like a lot of these things, to be honest, I didn't even know until I went to his site some of these things existed in ETF form. So it is very cool, but it's also, the disclaimer here is this is for the sophisticated investor, because like for someone who doesn't understand this very well, to talk about when systematic style premia is going to do well and when it's going to do poorly and like what that looks like, is it's above certain people's knowledge level. And even for me, I have to go back on some of these things and really look at it and say in detail like what's going on here with these funds. So you always have to be careful with these types of things, but it's like the exposure he's created here is really, really cool. And I also like the idea, like in these total return portfolios, one of the things he does that's very cool is he always uses min vol equities, or he does a lot, which is a great idea because you're trying to generate like a total return type thing. So also like bringing down the risk of the equity part is also a very interesting strategy when you're trying to achieve that type of thing, because like this wouldn't be a portfolio for like aggressive small cap value exposure, because aggressive small cap value exposure is going to add a lot of risk to the portfolio. It's going to increase those drawdowns. It sort of defeats the purpose. So this is a really good use of min vol equities too in this.
What I love about all the stuff that Nomadic Samuel is doing with this is when we think about, like in my world, thinking about it from risk mitigation and risky asset, what he's doing is he's kind of crowding everything into these like middle 2 categories of where he's saying like, I want to be flexible on my risk mitigating side, and I want that like hybrid income, whatever else approach in the risky asset side, and how it combines and it weights. It's a very, very different way to approach like the 60/40s and the stuff like that, where if you have the understanding of what you're going after and you can get those expectations together, it's really curious to me to want to play with these things and say, how would this work over time? How would this work if I'm saving into this thing, if I'm drawing out of this thing under various regimes, when the sequence risk runs into sequences of both adding money or pulling money out? It's kind of like a pure way to be in the center of this thing, as opposed to the where we started. If all I own is like an S&P 500 index fund and I don't know, like 10 or 5 year treasuries or something. Really, really cool.
And we'll put this performance chart he created on his website in the thing, not from the perspective of you should expect this performance to continue in the future, but just from the perspective of how he would think about creating one of these portfolios and like the important stuff you would look at. And what he was really focusing on is like the max drawdown, the worst year. Those are the types of stats you want to look at when you build these types of portfolios. And going back to our talk about sequence risk too, those are very important stats when you think about sequence risk. So, but again, the caveat has to be, and you talked about this, like thinking about this in different market regimes. I mean, these types of things can't really be tested, or at least not using a tool like this, can't be tested back that far. So, this is back to 2014. There certainly can be very different market environments than what we've seen since 2014. And anyone who runs these tests, me or anyone else, will tell you, you always have to keep that in mind. But it's a really interesting thing. And it's something it's opening these types of strategies to people. These types of things weren't open to people before. I mean, this was something sophisticated investors accessed through hedge funds. And now you can at least do it. But again, going back to our thing we talked about in the episode about Mike Green, about these new ETFs that are out there, it's always a double-edged sword. You've got to know what you're getting. You've got to know when it works. You got to know when it doesn't work. You've got to be able to understand what you can draw, the conclusions you can draw from a back test and the conclusions you can't draw from a back test. Like all of that is really, really important when you're looking at strategies like this. And the other thing, going back to what you and I talked about at the beginning, behavior again is huge with these, because whenever, like if you think about when we present like an S&P 500 chart back to like 1926 to a client, they're like, oh, this looks great. You know, this thing's pretty much up. I see that little move down in 2008, but that doesn't seem like that's big of a deal. Like that's what it looks like in a long-term context. And like, you always have to think about that in terms of any strategy you look at. Is like, when you look at these overall numbers, they tell you one story, but like with the S&P 500 example, they don't tell you what 2008 was really like. And in a portfolio like this, they don't tell you what 3, 4, 5 years where the S&P is just raging up and you're producing decent returns, but they're not as good as the S&P 500 and you're lagging. They don't tell you how hard that is to do. And for a lot of investors, that's much harder to do than losing money. And so that's always the thing, no matter who runs these types of strategies that are different than the S&P 500, they're different than the 60-40 portfolio. You've always got to keep that in mind. Is it's hard to test your ability to stick with this thing when your average, the average stuff is working. So the stuff your neighbor is in is working. At the cocktail party, they're talking about how much the S&P is up or how much their crypto's up or how much their tech stocks are up. And you're just sitting there trotting along at these low return rates. Like, it's very, very hard to do. And that's something to keep in mind when you try to run these kind of strategies.
Can't stress it enough with these two. This is different than private vehicles, but they're still new vehicles. And that's one of the cautionary notes on these things as well. I'm not saying there's a long-term capital management inside of one of these things or something like that, but I am saying these are vehicles with strategies that need to be executed, making some assumptions about that they can operate and do this type of business in the most liquid way they've ever been done. That doesn't always work out, and that's the other just kind of grain of salt you got to bring into this type of analysis on these things. Make sure you understand what you own, why you own it, and how you're going to survive the cocktail party when, you're lagging way behind.
Yeah, I guess the cocktail party is kind of just a general thing. Like, I don't think that really happens too much. Like, I kind of attended a cocktail party in a long time, actually. I don't know if you go to cocktail parties.
My life is cocktail parties, just cocktail party after cocktail party.
You're on like your tux and you head out to the cocktail party, maybe like a nice martini.
Throw on my smoking jacket. I same here. I don't know when, but I do know the cocktail party is the stand-in for every time we feel the fear of missing out, every time we have the experience of the imposter syndrome or whatever else, where we just feel like somebody else knows something that we do not. And should we be doing this? And that manifests in a lot of different ways. There's a lot of behavioral underpinnings to this. And that is a very real thing. When you choose to decide to be different in these areas and you choose to own something like levered min vol or something like that, you got to understand why you're doing it. And you better make sure that you have something ingrained in you that's stronger than the desire of whatever somebody else is going to say that makes them sound or appear smarter to you. Because if you can stick to it, that's what it's gonna come back to.
And just remember, people are only talking about their good returns at the cocktail party when they are good. You're not going to hear from them at the cocktail party when things are going poorly. So you always have to keep that in mind. If their returns were not good, you won't be hearing from them at all. If they're great, you're going to be hearing from them all the time. So
you're going to be hearing all about that wonderful meme stock or weird coin or whatever. Yeah. We all hear about that.
That's where it was really at its biggest. Like when crypto was really raging, like you'd always run into the person who's like, and people would like point to me like, he's a multimillionaire. He bought this random coin or something. Like that's when it really comes in. It's like, crap, why didn't I buy these coins?
Well, I'll never forget this person who came to me with their crypto problem years ago and being an accidental, gigantic return and then trying to help figure out the situation. And this was before the IRS issued guidance. And it's like, well, who knows what exists here for you. So you should probably assume you're going to have to pay taxes on some of this. But then it was gated to $10,000 increments. I don't even think it was a day at a time. It was like a week at a time that she could possibly extract some of this stuff. And this is the nuance. So I got to say this is just in the back of my head since we've been talking about it. I think I have at least, this is my album of the 60-40 is dead. You ready for this? I think I have one for us. My album for the 60-40 is dead. I think it has to be Hootie and the Blowfish, cracked rear view mirror. Why? Because that rear view mirror is always cracked. You think those back tests are going to tell you what's going to happen next? I got a message for you. Just have some professionals in your life that can think through the cracked rear view with you. I want to hold your hand, Jack, in the Hootie way, not in the literal way.
Well, now that we've done that, we can wrap up. We never talk about our day jobs too much on this, but we did today. So I will just mention, like, if you want to find out more about what Matt does, SunPoint Investments, me, Validea Capital. If you want to find out more about Nomadic Samuel stuff, pictureperfectportfolios.com. You have to be somewhat of a sophisticated investor to totally understand all the stuff, but it's really, really good. I mean, he's created so many really cool portfolios and so many unique blends of these things. So I would highly recommend anyone go there. And thank you, everybody, for listening, and we'll see you next time.
If you're listening to this, you care. It's okay to be curious about this stuff, and it's okay. You can still go and just buy 2 Vanguard funds and call it a day. But if you're curious about this stuff, hey, we are too. And that's really exciting. And I really love that there's just a place for us to have conversations like this in public, because you don't have to make it so simple, or even if you keep it simple, learning this stuff is really, really useful. So Jack, just thank you for putting these conversations in public.
Thank you. Yeah, I really enjoyed doing it, and we'll see everybody next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.